the fourth video on capital budgeting. In our previous video, we have discussed about net present value method under discounting cash flow approach. Now in the net present value method, we discussed about the theory as well as we discussed about two elementary problems on net present value method. As mentioned, that we will slowly build up this particular topic and we'll move into difficult NPV problems, and we'll try to solve those problems via certain video classes. Now the next problem which we are going to solve, let's go through the problem. A choice is to be made between two competing proposals. So project A and project B are the two competing proposals which has been given, and it requires equal investment of rupees 50,000 as mentioned, and are expected to generate a net cash flow as mentioned for year 1 to year 6. Notably, if you check project A year 4, the inflow is nil. So that is important. Cost of capital of the company is 10%. Cost of capital means to say, if the company is procuring capital from either internal source or external source. Internal source is within the business, maybe from the shareholders. External source can be maybe a loan taken from a bank or a financial institution. So the cost which is required to be paid by the company in order to procure capital is what is 10%. So naturally, as our objective will be, from the point of view of this particular problem, or this particular company will be looking forward to get something more than that of 10%. So the project has to be greater than that of 10% estimation. The following are the present value factors at 10% per annum. So the rate with reference to 10% discounting rate has been provided. So objective will be that the cost of capital is 10%. Our objective will be maybe the return should be higher than that of 10%. Now this we are going to discuss while we do internal rate of return in the next part. Today what we are going to do, we are required to solve this particular problem under NPV method, and we have been asked that which proposal should be selecting using NPV method, suggest the best project. So the project A and project B cash inflow has been given, as well as the discounting factor rate of 10% of rupee 1 is also provided. So what we do, we start solving this particular problem. So we got two projects here into consideration. So first is year, and we have 1, 2, 3, 4, 5 and 6 years in this particular problem. We also have got the investment for project A. So project A, we got a cash inflow figure. So the investment we are aware of, the investment is rupees 50,000. So project A is 25,000 for year 1. Then we got 15,000. These are all mentioned in the problem. 10,000. Now here comes one important thing, is nil. So we don't get any money in year 4. Thereafter it's 12,000, and finally is 6,000. Now let's refer to project B. Now project B, the initial first year I'm getting 10,000. Second year it's 12,000. Third year it's 18,000. Fourth year is 25,000. Fifth year is 8,000, and sixth year is 4,000. So this is what the information is that I have been given here, project A and project B. So and the discounting factor at the rate, so 10% of rupee 1 is also provided, which is 0.909, 0.826, 0.751, 0.683, 0.621 and 0.564. Now this has been given. We also know how to calculate this, so it will not be a problem if these particular figures are not given. Now what we require to find? We require to find out cash inflow. Now present value of cash inflow, the present value of cash inflow for both the project A and project B. So we require to find out the cash inflow, the present value. These are all future values. The present value of future cash inflow of project A and the future value of present cash inflow of project B. So what we do? So 25,000 into 0.909. So we are getting this as 22,725. Always use a calculator. Next we are getting 12,390. For the third year, this multiplied by this is 7510. Nil into 0.683 is basically nil. So we are not getting money here. Next is 7452 and 3384. So how we have calculated this? We have calculated the cash inflow of project A, the future cash inflow of project A as given, multiplied by the discounting rate. Similarly, we also calculate for project B. So what we require to do, 10,000 into 0.909 is 9090. For the next year is 9912. For the next year is 13,518. For the fourth year is 17,075. For the fifth year is 4968. And for the last year, the sixth year, it's 2256. So what we did? So we got information that there are 6 years given, and the future cash inflow of project A and project B has been given. And we find that in the fourth year, in project A, we haven't received any money. So these are said to be the future cash inflow. Discounting factor at the rate ₹1 is given in the problem. So what we did? We calculated the present value of future cash inflow for project A and the present value of future cash inflow of project B by multiplying this into this for project A and 10,000 into 0.909 for this one, and we got the figure. So if we add up, what we are going to get? We are going to get the present value of future cash inflow. So what will be this? This will be the present value of future cash inflow. So what will be the present value of future cash inflow of project A and project B? So if I add up, it is coming 53,461. You always use a calculator for this. 53,461, and for project B it is coming 56,819. Now we are aware of the fact that the problem itself is given that the initial investment has been ₹50,000. So investment, which is initial investment which happened on the 0th year, which is also can be termed as PV of cash outflow. So how we calculate this? So we put the investment figure 50,000 here. So 50,000 is the PV of cash outflow, which is the investment of 50,000 for both the project. So if I subtract this right now, so what I'm going to get? I'm going to get NPV. So NPV for the first one is 3461, and for the second one is 6819. So what will be the conclusion? The conclusion will be that because we have been asked that which proposal should be selected using NPV method suggests the best project. So what will be my answer? We are aware of the fact, and as per the accept reject rules of NPV, if my NPV is greater than 0, then we accept a project. Now if you check project A and project B, both has a positive NPV. So both projects are good. So we accept both the project. But if I have to select any one of the project, I will always select a project which has a higher NPV. So under this particular case, we will be selecting project B because it has a higher NPV. Since this has a greater NPV figure, so we will be select project B as the project to be selected where possible investment can be done. So I hope this particular problem is clear. This is as per the second problem which we did in the last video. So this is just making you understand that even though there is no cash inflow in the fourth year, still there is the rules and the regulations remain the same. So we require to discount it. 0 into 0.683 will be 0, so there is no issues with that. So the pattern of the problem remains same. Now let's move on to the next problem. If you refer to the next problem which we have, it says that from the following information, calculate the NPV. Again, we got two projects, and this time the two projects are project X and project Y, and we have to suggest that which of the project we can select, and the discounting rate has been given as 10%. Now here, see, the initial investment for project X is 20,000 and the initial investment for project Y is 30,000. So there is a difference in the initial investment. The next point given is estimated life is 5 years for project X and 5 years for project Y. Now here comes the most important thing. Now this is the first time you are coming across this particular point. Now there is a present mention of a scrap value. Now scrap value is rupees 1,000 for project X and rupees 2,000 for project Y, and thereafter the future cash inflow of project X and project Y has been given for the 5 years. Now what is scrap value? I said scrap value can be termed as a salvage value or can be termed as a residual value. Now this rupees 1,000 for project X or rupees 2,000 from project Y, when we are going to receive this amount, this salvage value amount or the scrap value amount of rupees 1,000, when we are going to receive? We are going to receive, see, if the life of the asset is 5 years, which means to say after the 5th year, I am going to sell that particular project X and will get 1,000 rupees. So I am going to get this 1,000 rupees at the end of the 5th year. So if you are getting rupees 1,000 at the end of the 5th year, it is also important that that particular amount, rupees 1,000, which you are getting in the 5th year, required to be converted to present value. So this is a completely new concept which you are understanding from this particular problem. So let's solve this problem. So in order to solve this problem, so we take again year into consideration. So we take year, and this time around we only have 5 years, 1, 2, 3, 4 and 5 years. We got the figures of project X and project Y. So project X inflow and project Y inflow. So project X inflow is how much? So project X we are getting 5,000 on year 1. Then we got 10,000 in year 2, 10,000 rupees in year 3. So please refer to the problem. 3,000 rupees in year 4, and we got 2,000 rupees in year 5. So similarly, project Y, we got 20,000 rupees year 1, 10,000 rupees year 2, 5,000 rupees year 3, 3,000 and 2,000 rupees in year 4 and 5 respectively. Now, the important point is, as I said, that we have to understand that the scrap value which we are going to receive or the salvage value which we are going to receive for project X is 1,000 and project Y is 2,000. We are receiving at the end of the 5th year. So it will be at the end of the 5th year again, we require to take the amount of the salvage value, which is 1,000 rupees for project X and 2,000 rupees for project Y. So we require to add this particular thing in the problem, because the scrap value you are receiving after 5 years. Now we are aware of the fact how we calculate discounting factor. This is nothing new to us. Discounting factor at the rate rupee 1 when the discounting factor mentioned is 10%. So we know it will be 0.909. We have shown you in the calculator how we calculate this. 0.826, so 0.751, 0.683, 0.621, and I will, since for 5th year I have taken 0.621. So for the salvage value, this is for the salvage value, so I will again take 0.621, the same discounting rate for the 5th year. Now if I calculate, so let me calculate the PV for project A and PV for project B. That means the present value of future cash inflow of project A and the present value of future cash inflow of project B. Now how we solve? So we need to use a calculator to solve this. So we got 5,000 rupees, 5,000 rupees multiplied by 0.909 for the first year. So we are getting, just a minute, we are getting it as 4545 245. For the next year is 10,000 into this, so it will be 8260. For the third is 10,000 into 751, so we are getting this as 7510. Now 3000 into 0.683, so 3000 into 0.683, so we are getting 2049. The next one is 2000 into 0.621, so 2000 into 0.621, we are getting 1242, and last one is 1000 into 0.621 is 621. So I hope this part is clear. So similarly, we also require to calculate for project B. Sorry, for we named it as XY. I'm very sorry. So this will be present value for project X and the present value for project Y. So let's calculate for project Y. So for project Y it's 20,000. So 20,000 into 0.909 is 18,180. For the next one is 10,000 into 0.826, so it's coming 8260. For the next one is 5,000 into 0.751, so 5,000 into 0.751, it's coming 3755. For the fourth year is 3,000 into 0.683, so 3,000 into 0.683, it's coming 2049. Then it's 2000 into 0.621, so 2000 into 0.621, it's coming 1242, and the last one is also 2000 into 0.621, 1242. So this is what we have got with reference to the present value of future cash inflow of project X and the present value of the future cash inflow of project Y. So what is the most important point here in this particular case is the salvage value. The salvage value also required to be taken and also required to be discounted. That's the important concept. Till date we were solving only for the first 5 years when we are getting cash inflow, but we were not discussing about a salvage value. In this particular problem we had a salvage value of rupees 1,000 and 2,000 for project X and project Y. Now this 1,000 and 2,000 of project X and project Y, the salvage value or the scrap value also required to be discounted as on the present year, because you are getting this particular amount, this true amount after 5 years. So if we add up, if I add up, what will be the name? The name will be the present value of future cash inflow. So what will be the present value of future cash inflow? So if I add up for the project X, it's coming 24,227, and for project Y it's coming 34,728. Now we also require to understand what is the total amount of investment which we have did. Now investment till now we are doing in the 0th year, and that is the reason why we are saying this investment to be the present value of cash outflow. In the next video we will be discussing on the fact that investment, if I do multiple investment, then also we also require to discount the investment part also. So I will be discussing that in the next class, in the next video. So what is the initial investment? The initial investment for project X was 20,000 and the initial investment for project Y was 30,000. So this is what has been given in the problem. So if I subtract this now, so what I'm going to get? I'm going to get NPV. Now how much is coming? So for the first project it's coming 4227, and for the second one it's coming 4728. Very close. Now here again the same thing. Both the projects has a positive NPV, so both the projects are good. But if I have to invest in any one of the project, I will select the project Y just because the NPV of project Y is greater than the NPV of project X. So I hope the basic elementary concept of capital budgeting which we were discussing is clear. In the next video we will be discussing on, there will be some special problem with respect to, see, till now the cash inflow, the future cash inflow which we were getting, we were discounting this. So we will be discounting this, but we were always saying that the investment was happening in the 0th year. Now this may not be always true. Investment will happen in the 0th year, but I can again make an investment after first year. I can make again an investment after second year. So if I make an investment after first year and second year, apart from an investment done in the 0th year, we also require to discount the investment part also. That means the cash outflow which we term it as investment, we also require to discount the cash outflow if you are making an investment in year 1, year 2 and hence. So that particular part will be discussed in the next video. I hope the concept is clear. Thank you. Have a good day.